Welcome to Commercial Conversations Over Coffee, the show where two college dropouts turned real estate millionaires discuss all aspects of commercial real estate investing. Now, welcome your hosts, Tyler Cobble and apartment guy Bruce Peterson.
So Bruce and I were just having a conversation about a multifamily asset that we've put an offer in on and talking about the difference between brokerage on commercial and multifamily. And I figured that'd be a good conversation for us to have on air. So I put that on pause. But we were talking about where, I'm representing kind of him, kind of the seller in this deal. And we're talking about who's technically paying the commissions. Because, Bruce, and obviously multifamily, it's very different.
Right. So, I think across all commercial, but definitely in multifamily, you don't have buyer's reps. They almost don't exist. They've not been part of this industry forever. But so usually what will happen is somebody will list a property for sale, and the broker is going to work for that seller, and that's it. So you have to be mindful of that when you're buying a multifamily asset, a commercial asset. Very often, you're not being represented unless you have your own attorney, which you damn well better have your own attorney, first of all. Even if you have your own representation, the attorney knows things that the broker won't know. But so the broker in the transaction, 99% of the time, will be representing this seller. So their fiduciary duty is to that seller, not to you. They're not going to purposely lie, mislead, or be dishonest. They can't. They're not allowed to. It's against the law. But again, they don't have your best interest in mind. They want to get as many dollars out of your pocket as they can because they're working for the seller. The industry is starting to come out with a few of these people that are representing the sellers, which, man, I think that's a huge miss. More and more people are getting involved. More and more people they don't have the experience, and they need as much help as they can get. And they're willing to pay somebody to be their representative and not just their attorney. So anybody listening that's a commercial broker, man, I think you should probably develop a portion of your practice and represent the sellers. Represent the buyers, because I think it's a huge miss. I know a fantastic one that I'm willing to share with anybody that's listening. If you're interested in buying in Central Texas, she's amazing. She works with new investors all the time. I'm not going to give her name out on the air, but if you want, put it in the comments. I'll direct message you her contact information. But it's a huge miss, and there's a huge market for it. I pay her 1% to 2% anytime I use her. I'm very experienced. I don't use her all the time, but if she brings me deal flow and I go with that, well, look, she did her job for me. So I want to give her 1 to 2 points of the deal. Absolutely, all day.
So why do you think it's so common in multifamily for the buyers to pay their reps? Because in commercial, commissions are paid by the seller on almost every.
No. I guess there was a miscommunication. No. I will only pay if I have a buyer's rep.
Right, that's what I'm saying.
There is no buyer's rep, so I'm not paying anything to buy it. The seller's always paying. And commissions I see are anywhere from 1% to 5%. I just sold a $23 million asset, and I paid 1 point. I sold a $2.7 million asset many years ago, and I believe I paid them 3 or 4 points. So, it scales. The higher you go, the bigger you go, the lower the percentage. So if you come into this space thinking, oh, well, commissions are always 6%, they get split. Well, that's single family. First of all, the commissions are a lot lower on a percentage basis. But secondly, if there is no, so the seller's rep, the broker in the deal, they will charge 1% to 3%. But there is no commission split in this industry. Right? They're not going to split that with your buyer's rep if you have one. So you're going to have to pay your own buyer's rep broker. So keep that in mind as well.
Yeah, it's interesting. We used to kind of work on multifamily, but the brokerage, we basically dropped that from our offering, representing buyers of multifamily a couple of years ago, because it just doesn't make sense. And I don't like having the conversation with my clients that, hey, you're going to have to pay me, because most of my clients are commercial guys that want to get into multifamily. They're not your traditional multifamily guys that are used to the process. And so they look at it as like, well, I've never had to pay commissions to have you represent me before. Why would I start doing that now? And it was just, like, well, there's like a handful of teams that control the deal volume in the Southeast United States for multifamily. So, we just send those buyers directly to those guys. And if they want to sell, they can call us afterwards, but it's not worth our time working on the buyer's front.
Gotcha. Yeah, that makes sense. So yeah, so when you're buying multifamily, because again there is no commission split, you are going to pay. No, that's not true. The buyer will pay their commission, the seller will pay their commission. So, there's a piece of the pie for everybody. But again, I think people with a multifamily commercial brokerage should develop a way to represent the buyer, because it's a huge miss, and people would be willing to pay.
Oh, totally. I mean, if the deal makes sense, the deal makes sense. People aren't, again, it's one of those things. I mean, if a broker brings you a good deal and you're not willing to pay 1% commission because the deal doesn't work, then the deal doesn't work, right? And those brokers aren't going to do that because they'd be wasting their time presenting deals that they don't think that you're going to buy. I mean, brokers are here to make money and get commissions. They only get that if you buy the deal.
Right. So when I started my education process, I was working with a coach, but I also hooked up with a great syndication attorney, and he was teaching me along the way too. Now, don't expect that from your syndication attorney, but he taught me a little thing here, a little thing there. But what he told me is like, look, when you bring a syndication to market, as long as you can keep the cost of the deal within 10% of the deal itself, that's fair. That's kind of industry standard. Now, I don't know if it still is. He hasn't syndicated for probably 20 or 30 years, but that's kind of my guideline, that as long as I can keep commissions, acquisition fees, brokerage fees, closing cost, all that stuff within 10% of the purchase price, that seems to be kind of industry fair. I've never come close to that. I'm usually 3 to 5% at the most. So, there's room in there for somebody to get 1 to 2 points. And a lot of people get short-sighted and go, oh, no, I'll represent, it's like somebody selling their own house for sale by owner. A huge mistake. Well, I'll save the commit. Yeah, but you don't know what the heck you're doing. It's going to take longer to sell it. You don't know how to stage it properly. Your pictures, I promise, they're going to suck. They always suck. Think about going on Zillow and looking at houses for sale. Anytime it says for sale by owner, they don't turn the freaking lights on. You need to pay for representation, right? So don't shortcut things. Don't shortchange things. Pay for legal representation. Pay for professionals in your world. And again, if you can find a buyer's rep in multifamily or true commercial, do it. It's worth it. It's absolutely worth it all day.
Yeah, I mean, if nothing else, it helps keep you arm's length, right? Which means that your emotions stay out of it. You have a broker that you can bitch to about everything that's going wrong, and that broker is going to filter it and present it in the best way possible to the buyers so that, there's no emotion that gets in the way of getting a deal done. I mean, that alone, in my opinion, is worth it. If you're walking somebody through your own house, you have so much emotional connection to that. You can't sell that better than a residential agent could. I mean, it's same thing with your own investment projects.
Right. So if you're buying from somebody that has a broker involved, right, they have a seller's broker. Remember, they're working for the seller, not for you as the buyer. So if you do have this bitching session with the broker, well, remember, they're not working for you. They're working for the other guy. They're going to tell them everything you just said to them. They have an obligation to do that. So you don't have an impartial person or somebody on your side in the deal. Again, that's why if you don't have a buyer's rep, which you probably won't, because they don't exist hardly at all, you have to have an attorney, please. Not just for contracts. You want somebody to be the intermediary between you and the seller's representation, because, you don't want these emotions to run hot, to tank a deal, to give you a bad name in the industry.
Yeah, exactly. Well, yeah, we were having that conversation before we went live, and so I figured we'd pause it and continue it on here because I figured that'd be valuable for some people to hear. But Bruce, how's your week been, man? What have you been up to?
How has my week been? It's been good. We're still working through all the damage. There's just damage everywhere on my properties. I just had the landscaping company come out and look at one of my properties in Austin. Just trying to get a bid together for the insurance claim. I'm probably going to lose $50,000 to $100,000 in landscaping too. I've got irrigation that all ruptured underground because, again, we got to zero or a little below zero in Austin, so everything's busted everywhere. It's fine. We're getting through it. We're going to make it through it. I spent a good hour and a half on the phone with an investor yesterday in that specific deal. He was totally cool, but he's concerned. He's like, hey, man, how's it going? What do we look like? How, so if you're going to be a syndicator, you have to expect you're going to have people call you, and they want to know. They've put $50 to $100 to maybe $500,000 in a deal. They want to know how their deal's going.
Yep.
So it's just part of the deal. But it's been a good week. Again, we've got 6 different projects in the pipeline right now between you and me, and just keeping us busy, hiring new people everywhere, which, man, that's fun because that means growth.
Yeah.
So that's what we've been up to. How about you?
Yeah, look at this. Andy's jumping in the live chat. Don't cheap out on professional help. Thanks, guys.
So you want to
Absolutely,
tell
man.
everybody who Andy is so they get the
Yeah.
context there?
Yeah, so Andy's my we call him the commercial analyst, but really he's my asset manager. So he's helping me on the development side, doing all the underwriting, and basically making sure that we do our proper due diligence and get everything right. So he's been helping us out quite a bit going on these projects. So Bruce and I just put another property under contract on Dickerson Pike, which hopefully we'll be bringing to our investors in the next 30 days. You think? And so
Yeah,
Andy's been
30.
doing. Oh, go ahead.
No, I was gonna say 30 to 45. Yeah.
Yeah, 30 to 45 days. So, call it mid-April, mid to late April. But Andy's been the one that's been scheduling all of the, property inspections and phase ones and getting everything going and as alongside the underwriting, which, helps us out significantly. So it's fun to have somebody that is as interested and involved in these projects as I am when it comes to that side of things. So that's been fun.
Right. Yeah. So 2 things. I just want to talk about Andy. So he weighed in. I just wanted everybody to hear that from you, that he has he has nothing to gain from this. He's not a broker himself going, oh yeah, don't cheap out. He's not a broker, right? So he's doesn't have an ulterior motive. But secondly, something that you talked about that I want to bring up to people. We do not do this podcast to get investors, to get mentoring clients, to get coaching clients, to sell education. We have all that. That is not why we're doing this. We're not trying to get investors. Having said that, if you hear the stuff we're talking about, we're always getting new deals. If you have interest in looking at what we're doing, let us know. You got to reach out to us. But most of the deals that we do, if you hear about it on the air, we're not going to go into specifics. We're legally not allowed to on most of these deals. But if you hear us talking about something, go, oh, I want to hear about that. Well, you're too late to get into the current deal because we don't have an existing relationship with you. So reach out to us, schedule some time. If you're local with Tyler, local with me, call us. We might be able to sit down and have coffee if you're comfortable with that. If nothing else, let's start a dialogue on the phone. Let's get to know each other. We have to have an existing relationship on almost all of these deals that we do before we're allowed to let you into a deal. So again, the Congress in that we just put under contract, if you hear about it, you think about it, and you want to get involved, if we don't have an existing relationship with you, going back 2 to 4 weeks from now, or months, you can't participate in that deal because of the way we're going to structure it. But again, reach out to us, let us know your intentions. We're glad to bring on investors, but that's not why we're doing this at all.
Yeah, absolutely. I mean, Bruce and I do mostly 506B syndications, and I know that we've covered that a little bit in the last episode or two. So those are essentially what are called friends and family raises. So we have to have a pre-existing relationship with you. The 506C, we've done one of those. That's anybody can come in, but you got to be accredited. So I think we're probably going to be sticking to 506Bs for the foreseeable future. Those have done well for us so far. So, again, we have to have
and
that
it allows
pre-existing
us to bring in some of our friends and family that aren't accredited. And that's why we really do it. We could go out and do 506Cs all day, raise the money, no problem. We can advertise and all that. But, just to be frank, not all of our friends and family are accredited investors. And so we want to always be able to bring things to them as well. Like on a deal that we're looking at doing ourselves, myself and my wife, we're going to do a 506B because the first property manager I ever had in this industry when I get involved, she reached out to me 6 months ago, said, hey, you have anything? I finally have some money saved up. I'd like to start investing if I can. So I want to bring her in. I want to bring in people like that. Some of our staff that might not be worth $1 million. They do well, they get paid well, but they're not worth $1 million. Well, now we can bring them into our deals. So, a lot of people hear, oh, 506B, don't ever do those. Those are dangerous. They're hard. Well, 506Bs, there's reasons to do it. And that's why we like to do a lot of 506Bs.
Yeah, exactly. So speaking of that, talking about structures and everything like that for syndications, this episode we're going to be talking about part 2 of structuring your syndication. Look, Bruce and I could probably have a whole series on structuring syndications, different models, different ways you could go about things, how to pitch to investors, et cetera, et cetera. But there were a few points that we didn't cover that I feel would be important for us to talk about today. So, Bruce, what were those points that you'd like to talk about?
So the last two things that we didn't really have time to hit on was the return on versus return of investment and then the subordinated structure. So I want to go through those really quickly. And again, these are things that maybe won't come up for you in your deal. Well, they will come up. I shouldn't say that. They'll always be in play, whether the sponsor knows what they mean or not. Whether you're investing passively in somebody else's deal and they don't talk about it because they don't know to talk about it. I can't speak to that, but I want you to know this is what's always going on in every one of these deals, whether you understand it and specify it or not. Right. So let's start with they intertwine very well together. So we'll start with return on versus return of. When you do a deal and you're sending out distributions to investors, you can do it in a way that's considered a return on their investment or a return of their investment when you send out cash. So you basically have three main ways you're going to send cash out to people. You're going to have operational cash flow. So you have rents and income, you have expenses you have to pay. Whatever's left over is considered free cash flow after you pay all of your expenses, your debt service, all your capital expenditures, everything, your asset management fee. What's left is free cash flow. That's what you can decide to distribute to the investors. You have that. You also have refinance proceeds and you have sale proceeds. Those are the three main things that will come out in the way of distributions. When a distribution comes out, let's just start with a operational cash flow. Right. So again, you have your income minus your debt on a monthly or a quarterly basis. Whatever's left over is the cash flow. You send that out to your investors. Let's say the investors cumulatively contributed $1 million. 10 people contribute $100,000 each. So there's a total of $1 million contributed. And let's say in year one, you send out $100,000 in distributions. If you consider that a return on their investment, that means their investment stays there and they're making money on that money. You're not returning their money to them. You're giving them a return on the money they've invested with you. It sits in a capital account, basically, in the bank, not a separate account. You have to account for it separately in the accounting software, but it'll all be in the same bank account. So you don't have to get that crazy with it. Don't open a different bank account for all of your investors. It's a nightmare. But so you send out a $100,000 distribution for that year. That return on investment does not lower the value of their capital account. If you do it as a return of their investment, which I'm invested in a restaurant, that's the way they've decided to structure it, and I was fine with it. So when the same scenario, we send out $100,000 in distribution to the investors, it's a return of their investment now. So their capital account, remember the capital account for the investors together was $1 million. I send out a $100,000 distribution in a return of scenario. Their capital account now is paid down and it's now $900,000. That matters on the back end when you do a refinance or you do a sale. So, but again, that's basically the difference. Many syndicators, I would even say most newer syndicators, they have no idea what I'm talking about. And that's scary, right? Do you need to know what those terms mean? I guess the deal will work with or without it because it comes down to, are you able to operate a profitable deal? But these are things that you should know as a passive investor, and you damn sure have to know or should know as a syndicator. So that's the two big things. Remember, return on means they get money based on how much they've invested, but you're not returning their money to them. And a return of is you're sending their money back to them. So at the end of 10 years, if you send them $100,000 back every single year for 10 years, because the profit was good, at the end of the 10th year, they have all of their money back. They have no money left in the deal, right? So that's the way it works.
So how do you typically structure your deals? I mean, are they return of or return on?
At the beginning, because I didn't completely understand this. People were explaining to me, they were teaching me, I was learning, but you're drinking from a freaking fire hose at the beginning. I didn't do anything wrong, illegal. I didn't screw up. I just didn't know. I didn't fully understand the concept of return on and return of. Return on is a little better for your investors. And I'll explain that when we get to subordinate in just a second. It's a little better for your investors that way, but I didn't understand that. I just thought, okay, well, return of, I'm sending money back to you. So it's, I'm sending some of your money back. So I did it as a return of. But since then, after my first two deals, I started to finally, really, it's the 10,000 hours, right? I just kept learning incrementally all the way. And I went, It's in the best interest of my investors to do a return on their investment. So now all of ours are done as a return on investment for cash flow. Now
So
on the cash out refi, that kind of thing, and the sale, we do those as return of investment. But on the cash flow distributions, we always do return on now. Go ahead. I'm sorry.
So is that because return of pays down the capital accounts, meaning the investor has less money to get that return on every time you pay out a distribution? So their returns start going down?
No, no, really where it comes in. So let's talk about subordinate now, the subordinate structure. This is where it matters. So subordinate means it refers to the deal sponsor or the syndicator. Is the deal syndicator, is the sponsor subordinate to the investors or non-subordinate to the investors? So let's take a sale, for example. Let's say our same example, we've invested $1 million as an investor group. We've held it for 5 years. Now we're going to sell. Over those 5 years, we've returned $100,000 to the investors every single year. So in a return of investment situation, their capital accounts have been paid down to $500,000. Now, subordinate means, let this go with subordinate. So subordinate means the investors get paid before I get my promote as the sponsor. So in the situation we just talked about, it's a return of on their cash flow distributions. At the end of 5 years, they've gotten $500,000 of their $1 million back. So they only have $500,000 left in their capital account. Let's say I go sell the property and we get $1 million profit. The first thing I have to do, if I'm subordinate, I have to pay off the remainder of those capital accounts. So I have to give them $500,000 back. So now they're made whole. They got $500,000 through distributions, cash flow distributions, and I gave them an additional $500,000 out of the sale proceeds. They got all their $1 million back. Now, from there, every other dollar I get my promote on. So if it's an 80-20 or 70-30, so I would get my 30% promote on what's left, that remaining $500,000. The investors would get 70%. Let's flip it. Let's say I'm not subordinate. I'm not subordinate. So same exact example. $1 million invested, 5 years, they've gotten $500,000 in distributions. Remember, we're calling it a return of in this example for their cash flow distributions. We go sell it, we get $1 million profit. I am not subordinate. So before I take my promote, I don't have to zero out their capital account. I take a 70-30 split on every dollar that comes out. And I'm not saying that's a right way or a wrong way. It's just different ways to structure it. You have to decide as a syndicator, how do you want to do it? What does that do to the projected returns to the investors? If it hurts the investor return too much, you probably shouldn't do it that way because it's going to be very hard to get investors. On the other side, if you're an investor and you look at it and you think it's a return of on cash flow distributions and they are not subordinate. Well, okay. Oh man, that's really hurting the return. I don't think I want to invest in this. I wouldn't say don't invest in a deal just because it's a return of or a return on. It's subordinate or it's not subordinate. Look at the projected return using the structure they're going to use. And do you feel comfortable with the projected return they're showing you? If so, well, then invest. Well, also, are you confident in their ability to deliver on those projections? That's it. So again, subordinate, the deal sponsor does not get to promote until the capital account has been zeroed out. Let's take that last step. Let's say your cash flow distributions in the deal are treated as a return on. So you've held it for 5 years. You've gotten $500,000 in distributions. It's a return on their investment now. So that's not paying down their capital account. So when you go to sell the property now, you get that same $1 million profit. Well, your capital account is still the $1 million. So in a $1 million profit with a $1 million capital account, well, there is nothing left over after you pay off the investors, right? So you get no promote. Again, it's not a right way to do it. It's not a wrong way to do it. That's the way the two different structures work. You just have to understand it, be comfortable with the way that's being explained to you. If you're the deal sponsor, you have to understand how you structure these deals, what effect that's going to have on the investor. It's important to know what effect it's going to have on you, but it's more important to know what effect that's going to have on the investor because they're the only ones that matter in the deal. If you don't give them a good deal, they won't invest with you again. So you've got to take them first and then figure out if I take them first, Is the deal strong enough for it to be worth it for me as the deal sponsor? And if not, well, then you probably don't want to do that deal yourself. So hopefully that helped, but that's kind of the basics of return on, return of, or subordinate or non-subordinate.
Yeah, I mean the mentality that I always recommend people take when you're looking at structuring a deal is the high tides raise all ships, or the more the merrier kind of thing. You know, can you go out and negotiate for the best possible terms for yourself as the GP or deal sponsor, and make a ton of money on a deal and get your investors the bare minimum returns? Possibly. I mean, you may be able to raise capital doing that, but the guy that goes out and gives his investors a better return, and he's willing to give them a higher percentage of the deal, or he's willing to take less, or anything, anything to that extent, he's going to have an easier time raising capital, and you may lose your investors to him on the next deal. So it's important to put your investors first and just figure out what makes them want to move with you, because a lot of the guys that I see that are very successful, they have a bunch of investors that go with them from deal to deal to deal, which
I
means
have
they
many
don't
of
have
them.
to constantly. Yeah, exactly. Bruce has a ton of investors like that, where it's like he doesn't have to go out and constantly meet new people to get them into the next deal. He builds up a list of people that have invested with him before and just calls them for the next one.
Exactly. So, I'm going to give an example of something that I'm working on right now. If I get this deal under contract, I'm going to tell everybody listening what the deal structure on this one will be, right? And I'll explain. So, again, we've explained concepts. Now, you blend that together however you choose in your own offering. Can you go sell that to the investors? Can you perform for the investors? That's what it comes down to. So, I've got a property that I'm looking to purchase, and we hope to be under contract either today or sometime next week. My approach is we're buying a non-stabilized property, meaning it's not fully occupied yet, so it's not profitable. Totally fine. I'm okay with that. I go in with my eyes wide open. I know what I'm buying. I know we're not profitable right away. I have to bring some money into the deal to pay the bills while we're not profitable, to get on a sidetrack here. Got to remember that stuff too. But on this deal, so once we get it leased up, which we think we will get it leased up to 90 or 95% or better, and that's stabilization. Stabilization technically means 90% occupied for 90 days in a row. That's kind of an informal definition of stabilization. We think we can get it to stabilization within the first, probably 4 to 6 months of owning it ourselves, maybe 9 months at the outside. Once we get to stabilization, now the property value has gone way, way, way up because we took something that was in, maybe not the best shape, in best condition. It was losing money when we bought it, but we know how to go in now and fix it. We know how to spend money on the asset, asset, improve the amenities, make it a nicer place for people to want to live, fill it up, and make it profitable now. So, in this situation, by the end of the second year, we should be solidly profitable, and we're going to do what's called an exit for the investors at that point. So, what we're going to do is we're going to say, first of all of your distributions that come out will be treated as a return on your investment. So, I'm not lowering your capital account with every distribution that comes out. But at the end of the second year, I'm going to give you an exit. Investors want to move their money quickly. The quicker they can move their money, the quicker it grows. So, at the end of the second year, the projection is I will give you an exit through a cash out refi. At the end of that second year, we'll go back to the bank and say, hey, it's dramatically more profitable now. I would like to take out a loan on this new value we created. I will get those refi proceeds. I'm going to give every single dollar to my investors. I will take none of it, because what I'm going to do now is I want to get you an 18% IRR by the end of the second year. I'm going to pay you out, buy you out, and now I'm going to hold this asset for the next 30 to 40 to 50 years. Investors don't want to hold an asset that long. They want to turn over their money, right? So I'm going to buy them out, give them a fantastic return, and do it in only 2 years, provided that refi will give them an 18% IRR or higher. At the end of the second year, if I can't deliver at least an 18% IRR for my investors, then we won't do that. We will still give them their exit, but instead we will now sell the property. I want to hold it for 50 years, but I also have to take care of my investors first. If I can't get them that 18% IRR by doing a refi, fine. It's not the way I wanted to do it, but I'll sell the property. I'll get them their 18 or better IRR at that point. We will all move on to the next deal. That's the way I'm going to structure the deal that we're probably going to have under contract very soon. Um, Again, it's just a blend. We've talked about concepts. This is what I'm going to do on this project. It'll be the first time for me to do this type of structure. It's my job as the sponsor to be able to explain that clearly to the prospective investor. It's going to be a 506B, so I can't invite anybody into this deal that I don't have an existing relationship with. And again, I'm not raising money. I'm not looking for anybody listening to us to give me money at all, but just to make sure you understand this. You hear this, you go, "Oh, Bruce, I want to be part of that." You can't be part of it unless you are listening to this and you already know me or good friends. Maybe you've invested with me in the past. You're not allowed to come into this one. You can come into one later after we've established this relationship. Again, I just want to help give real world examples of the concepts we're talking about. Hopefully that helped.
Yeah, that's pretty interesting. I mean, that's a good fallback to have, right? To, hey, we're going to refinance and we're going to aim to get you this IRR target. If we can't, so be it. We sell it and we'll hit it.
Well, and that's the beauty of these deals. You can be as creative as you want to be as long as you can explain it. They understand it. I've got contingency plans. We're going to do a cash out refi at the end of the second year. I'm going to get you an 18% return or higher at the end. Well, the contingency plan is if that doesn't work, well, I can still take care of you. We'll just sell it instead. Not what I want to do, but you know what? I'll take care of you first instead of owning it, which I want to do. You know what? That one just didn't work out maybe. My numbers show that it will easily work out, but I always have to have fallbacks, like you said, always.
How many investors do you come across that kind of carry the same sentiment that like, hey, no, let's own it forever. I want to stay in a project like that?
Well, not very often, right? Now, very, very few, I would say. I'm sorry, I'm going to change my elevation here a little bit. I'm tired of standing. But most people do want their money back, fairly quickly as possible, right? And that's usually about a 5 to 7 year hold period for most people. Most people don't want me to hold it for 10, 20, 30, 40 years. They want their money back at some point. So it's very, very rare. On the sponsor side, I don't see this process either. Almost always, deal sponsors that I'm seeing, they always project a sale at the end of year 5, 7, or 10, and that's fine. But I'm trying to get some stuff that I can, leave as a legacy to my two girls. I'll be honest. Maybe it's a little selfish. Now, I'll give you a fantastic return in the process. But again, an investor doesn't want to hold it for 50 years so I can will it to my kids, right? They need to be paid out at some point. So that's why I'm doing it. And I'm doing a little more of these deals. They only work if I can buy a deeply discounted property that's beat to hell. It's very low occupancy. It takes the right deal to be able to execute something like this. But when I can find them, this is probably going to be my structure for a while. Again, I want my kids to have a legacy. That's why I'm doing this. That's why most of you listening that have an interest in starting this yourself, you're trying to have more freedom in your life, more time to give to your family, to give to charity, whatever. But you're also looking for a legacy very often. What can I do to set up my family generationally? That's what I'm trying to do. So we're going about it a little differently. And I think maybe more and more people will do this, but most people won't.
Yeah, I mean, the velocity of capital for limited partners is obviously very important. If you, and since a lot of these deals are based on internal rates of return, the longer you own it, the worse, and I'm putting that in quotes, the worse of a return you get, right? So, I mean, over 20 years, that IRR is going to plummet, but your cash on cash could still be really high.
Yeah, simplistically speaking, you're right. Now, in a vacuum, right? Every deal's different. Sometimes holding it for 10 years will give you a better IRR than holding it for 2 because something happens in year 10 that explodes the value. Mm-hmm. So every deal's different, right? But, on average, yes, the longer you hold a deal, typically the IRR starts to go down. You're right.
Yeah. So, I mean, most of these multifamily deals are 5 to 7. Have you ever seen anything that's like 15 to 20?
Never. I've seen 10, and I'm starting to see that more and more because people are paying up so much for these properties that it takes them longer to hit a break even and a profitability standpoint on a sale. So I'm seeing more people start to structure 10-year holds, and it is what it is. If you've got an investor base, that's okay. Holding it for 10 years, nothing wrong with that at all. But most of the time, until the last 12 months, most of the deals I see are 5 to 7 year holds.
So if investors start buying these on 10-year holds, how do you think that's going to impact the multifamily investment industry? Because
Well, you're going to have lots less deal flow, right?
right,
Because then your deal flow is going to, because honestly, most projections are 5 to 7 year hold that I see, right? But I think most of the industry turns over every 2 to 4 years right now. If you get to where everybody's holding for 10 years because they're paying up so much right now, yes, it's going to take a lot of inventory off the table every single year. It's going to be harder and harder to find a deal. So we'll see how that plays itself out. There's all kinds of outliers that we don't see that could happen to change all this. But in a situation like this, what's going to happen? It's a market cycle, right? You're going to see a lot of development happen to try to solve this shortfall of inventory. As that spikes, that will flood the market. Maybe not flood, that might be too strong a word, but it will put a lot more product on the market. So it'll start to keep prices in check a little better. So now we can probably get back to a 3 to 5 to 7 year hold. So it has a way. That's the beauty of a market. It's not always efficient, but it usually always balances itself back out.
yeah, I mean the problem that we're having with new construction right now though is that prices are so high to build new construction that either
Oh, yeah.
developers are sitting on them for a little while to get a return and then selling them, or they're having to sell them for such low cap rates and people are still paying for it that it's hard to see at what point that will actually impact the market, right? I mean, you look at these three story garden walk up style apartments, and those take 12 to 18 months to develop, and that's once you've got entitlements. If you're going for more of a podium, that can take 20 to 24 plus, depending on how big it is. So, I mean, if buyers are starting to sell their investors on these 10-year holds now, it could be years before, inventory starts to pick back up, which is really interesting to think about.
Yep. Remember, we're always educating, and I'm not as well versed in true commercial as you are and development. So I'm going to hear things, and you do the same thing with me all the time too. That I want you to back up, explain podium to people that are listening, and explain. You said 2 to 3 story garden walk up. Can you explain what those terms mean for everybody?
Yeah, okay. So a garden style apartment complex is one that's surface parked, meaning there's no parking garage. You're literally just parking outside, and there's no elevators. So it's literally a walk up. So they are typically 3 stories because that is the maximum amount of stories that you could have in most municipalities without having to install an elevator. And so developers will do that because their cost per unit is significantly lower than if they did 4 stories. So there's, again, it also depends on the type of market, right? Like you're not going to go into downtown and build a walk up. You're going to go out to suburbia and build a walk up. Because that's kind of what people expect. Now, where you're paying very, very high prices for your dirt, you're going to want to go as tall as you possibly can in order to recapture some of those expenses. So you're going to do what's called podium construction, which is basically where you dig down into the dirt, you build a parking deck, and then you build your apartment complex on top of that. That is very, very expensive to do, depending on where you are and what style parking garage you're doing. It could be anywhere from $20,000 to $100,000 per parking space added. So it's
Wow.
very, very expensive.
So that's why,
But
for that to make sense, you have to build very tall
right,
because you have to get more units out of the same square footage that you have for dirt. Okay.
that's exactly right. That's
Yep.
exactly right. So to do 200 units downtown is way, way more expensive than 200 units, out in suburbia. One, your dirt's cheaper, but you're building on more dirt, right, out in suburbia. So you have more room to spread out. So that's why rents in suburban locations are so much cheaper than rents in downtown. It's market demand, right? I mean, people want to live downtown where they can walk to live, eat, play, whatever. But also, developers have to get those rents because construction is just so expensive.
Yep. Great
So
explanation. So hopefully that helps some people because, again, people that are coming through my channel to find this podcast are like, they know multifamily, and we're not buying for the most part downtown. So, yeah, I think helping them understand what podium means and the dynamics that go into why do I want to build higher? Well, that's why. So, great explanation. So, do you
Yep.
want to start getting into compensation types?
Yeah, let's do it. What's your favorite?
Well, what's my favorite? Well, it's the one that everybody knows, right? It's the basic. It's the promote. So
Yep.
you've got to promote, and we've talked a little bit about that in the past. But that's so for me. There are four main ways you can compensate yourself. You could do it through the promote, which most people know about that. You have an acquisition, disposition, and refi fee. You have an asset management fee if you're going to perform that duty, and then you've also got what's the other thing? A management fee if you own your own property management company or if you're going to manage it yourself. So, but of those, I like to promote. It could make a pretty good sized chunk of difference to yourself. Now, all of them pay well, but the promote is kind of spread out. When you take acquisition fees, disposition fees, that kind of thing, those are big chunks all at once. And that can cause some pretty hefty tax consequences if you're not careful.
There's so many different ways to make money as a deal sponsor. I mean, Bruce, how many did he just name off? Like 4 or 5 different ways. There's obviously reasons behind every single one of those. I mean, like an acquisition fee. Well, there's a lot of work that goes into that, right? So, you're thinking, well, you're part of the deal. Why do you get paid an acquisition fee? Well, when you're going through an acquisition, Bruce is working on it. I'm working on it. Andy's working on it. Jordan's working on it. Stephanie's working on it. Catherine's working. We've got all these people that are putting time and energy into this, and somehow that's got to get paid for. So that's what those fees go towards. But let's dive into. I mean, before we get into the individual ones, let's just talk about promote. I mean, can you explain what a promote is and how that's paid out?
Right. So the word promote comes from promoter, right? As a deal sponsor, you're technically considered the promoter of the deal. You're promoting this deal, trying to raise money from investors to go out and execute on this deal. So that's why it's called a promote. But it's basically your compensation fee piece for the management, outside of the acquisition, right? Because Tyler just talked about what that was all about. But this is to operate the project throughout its entirety, right? So you're going to get, if I'm not going to get paid some kind of a premium for running this deal, well, then I would never do this. Nobody would ever be a deal sponsor, and there would never be anything to invest in. So there's a lot of liability, risk, stress, and just a ton of work that goes into these things. So if you're the deal sponsor, almost without exception, you're going to sign on the loan. You have a risk that the limited partner does not have. Again, I have to run the deal. So let's say you don't even have a property management company. Say, Bruce, I'm going to give that to somebody else. Yeah, but you're probably going to be the asset manager. And as the asset manager, it's your job to oversee, hire, and fire the property management company, right? So you're dealing with that. If the deal doesn't perform, you're the deal sponsor. You can't say, "Oh, it's not my fault. It's the property management." You're in charge, dude. You got to make sure it delivers, and you got to fire that property management company or work with them to figure out why it's not performing. What can we do to make it perform? So again, there's a ton of work. There's a lot of stress. We go through COVID-19. We go through this great, what are they calling it here? Snowpocalypse or ice apocalypse, whatever the hell they called it that we just dealt
Yeah.
with in Texas. That's stressful as hell. I have lots of displaced residents right now. I have staff working till 10 or 11 o'clock at night almost every single night. And I'm not kidding about that. They really, really are. So there's a lot of stress. I have to be able to go back and talk to my investors, tell them why this is going on, what's happening. The person I talked to yesterday, I had to be honest with him. I don't think we're going to be able to do distributions for a little while because we're spending so much money trying to repair this property. Yes, we will get insurance proceeds, but I can't wait for an insurance check. I've got to put this back together as quickly as possible because right now I don't have any units I can lease. If somebody comes up and says, "Hey, I need a place to live. Can I rent a place for?" Normally, yes, sir. I don't have anything. Right, 15% of my property is unoccupiable. So even if I'm 100% occupied right now, it's only on 85% of the units. So, there's a high likelihood I'm not going to be able to send out distribution checks for a while we put it all back together. Once we get the insurance proceeds, yes, now I can send out those proceeds because we've already paid for the rehab. We're getting reimbursed. So those are the conversations you have to have. That's where the stress comes in. Like I said, it's stressful, it's hard, lots of work. There's a lot of liability. You're signing on these loans. That's why you're getting these promotes. Typical promotes that I see are 20 to 30%. Again, if you've listened to these podcasts in the past, you've heard me talk about, I've invested in, one of the hottest restaurant concepts in Austin. Their promote is 55%, but their numbers still worked for me, and I had confidence in their ability to execute on their plan. So that's what a promote is, and that's kind of the numbers that I usually see in this industry.
Yeah, usually the limited partners won't be signing on the debt. That's very atypical unless there's some sort of incentive to do so. I mean, we've gone through that before where there can be a percentage given or an additional promote given to the debt signors. Not typical though, right? Again, as Bruce and I keep saying, I mean, there's any number of ways that you could structure this deal. It's funny, whenever we're talking to people who are very interested in investing in real estate, but they haven't gone through a syndication before, we're talking to them about a deal. They're like, well, do you think this is a good deal? I'm like, well, Bruce and I are going to be signing on the debt for this. So we damn sure believe this is going to be a good deal because, in a worst case scenario, right? I mean, let's say somehow real estate goes to zero, LP investors lose all of their money. Bruce and I lose all of our money and we still have to pay back all of the debt. So, as the general partners, you're taking on a pretty significant amount of liability when you're going through these projects, and you've got to understand that. And so I make sure that the LPs know that that's the case.
Right. So let's break that down a little bit, right? You said, so, you lose all your money as an LP, but we lose all of our money plus. Now, let's talk about that a little bit. For people that are going to be their own deal sponsor or syndicator or sign on somebody else's loan for a piece of compensation. You got to be compensated for taking that risk if you're an LP. Okay, so let's say some people listening to this, especially in the multifamily space, they go, oh, no, you get non-recourse debt. They can't come after you for, okay, you're right. So we'll break that down. Let's say we sign for a loan and we get an $8 million loan on a $10 million property. We get non-recourse debt. Right? That means that if we try everything we can, we try to make this deal work, we can't make it work, we end up having to give it back to the bank. Well, it's non-recourse. As long as we haven't been bad actors, done anything fraudulent or illegal, we're not on the hook. If we give it back to them, they gave us an $8 million loan on a $10 million asset. Let's say we have to, the bank now has to sell it at a 20% discount. Oh, holy crap. Well, you paid $10 million for it. They have to sell it for 20% discount. They're going to sell it for $8 million. Well, that's all your loan is. So even if they have to take a 20% hickey on the deal, as long as it satisfies your note, they come out whole. That's not what the bank wants, though. They don't want that. They want you to service your loan. They want you to make your interest payments, and that's their business model, right? But in that situation, you're fine because, first of all, you're non-recourse. So they can't come after you personally after they've taken the property from you. So they can't ask you to pay back a shortfall. So let's say they had to take a 40% discount to sell the property and they can only sell it for $6 million instead of $8 million. Well, now there's a hole of $2 million. It's non-recourse. They cannot come after you personally to satisfy that debt unless you did something illegal, fraudulent, or unethical, things like that. There are some bad boy carve-outs. Now, if you sign on recourse debt, meaning if you try your best to run this deal and it doesn't work out, you have to give the property back to the bank or the lender. And the same scenario, they have to sell it for $6 million and it was worth 10. You have an $8 million loan on it. Okay, it's recourse. Now they are coming after you. They are absolutely coming after you for that shortfall. Non-recourse is safer, but it comes with hellacious prepayment penalties. So there are reasons that you may not want to do non-recourse. It's not always the best idea. But let's say you're an LP, you're an investor, and you're going to sign on somebody's loan for them. And let's say it is recourse. And the scenario comes up where it's a $10 million purchase, $8 million loan. They sell it for $6 million. There's a $2 million hole. Almost every one of these, when you're signing on these deals, the recourse liability that you take on in a recourse situation, it's called joint and several. That means if there are three of you signing on the loan, well, there's a $2 million shortfall, so all of us have to come out of pocket $666,666. That is not accurate at all. If it's joint and several, which most of these are, they're going after the biggest dude at the table. If I'm worth 200 million, Tyler's worth 100 million, and the other signer's worth $1 million, they're coming after me first because they want to do this as quickly and easily as possible. They're going to come to me first and try to take that $2 million out of my ass. If they come to me, they get all they can, but they can only get $1 million out of me because that's all I have. Well, next they're going to go to the next person. Now they're going to go to Tyler and try to get all of it, all the rest of it from him. If between the two of us, we can't satisfy it, then they're going to that last person. Joint and several means you're on the hook for the entirety of that loan. And if you're the biggest balance sheet on that signature line, they're coming after you first. And they're going to take it all out of your ass. Now, you can go try to sue your partners if you want to, and you probably would in that situation. But I just want to make sure that people, because a lot of people blindly sign on loans. Oh, I'm going to get compensated for it. Dude, you better understand what the hell you're signing on. Again, that's why we get promotes, because there's a lot of liability and risk. There's no problem signing on somebody else's loan. I do it. I have done it. But you better understand the terms of that loan before you do it.
Yeah, and you're probably also wondering to yourself, well, why would you sign a recourse loan, other than what Bruce mentioned? I mean, in commercial, you don't really have a choice. I mean, that's how commercial works. Multifamily can get non-recourse because typically you have many tenants and it's residential. It usually doesn't have these massive ups and downs. Now, multifamily, you won't see quite the returns that you'll see in commercial. I mean, there's a trade-off for that, right? It's a risk-reward system. So, the banks are looking at these notes as what's risky, what's not. Okay, multifamily's not risky really to a certain extent. We're fine doing non-recourse. Commercial, it's a little riskier. We're gonna need recourse. Development, that's very risky. We need recourse. So you look at it. Just depends on what kind of project you're doing, honestly. So, I mean, if Bruce and I are doing all these commercial developments and we're willing to sign on the note, clearly we believe in them, or we wouldn't be willing to do that. And so, as the deal sponsor, you got to think to yourself, am I willing to sign on this note? How much do I believe in this project? One, are you willing to go put your neck on the line with investors and take money from them? But two, are you willing to put your own balance sheet and financials on the line for the project as well? I mean, it's not a small responsibility. And I feel like over the last few years, becoming a deal syndicator, a deal sponsor is like the new cool thing to do, and everybody's getting into it. It's like when we were coming out of 2008, all of the Chucks in a truck became general contractors. You're like, man, this guy that I saw laying flooring yesterday is now building a house, and it's so different. It's not that easy. You can't just go from one to the other. Just because you've seen an electrician do work doesn't mean you understand how to schedule an electrician to come in and do everything properly. So I feel like the same thing is happening with syndication, and particularly multifamily syndication. It's the new cool thing to get into and do, and so it's there's probably a lot of people out there that don't realize or don't fully appreciate the risk that they're taking on by becoming syndicators.
Right, and I know this is supposed to be compensation types, and but that's why we do this for an hour and a half, right? So we have time to really deep dive into things. So we'll get back to the next compensation type in a second, but one last thing I want to talk about. Okay, if I can get non-recourse debt, well, I always want non-recourse debt based on what Bruce and Tyler said. Not necessarily. Let's say you are in multifamily and non-recourse is an option. It might not be the right option for that deal. What it comes down to, again, non-recourse, almost without exception, it's going to be Fannie and Freddie for the most part, Fannie Mae and Freddie Mac. These agency debt providers, loan providers, they are going to give you non-recourse, but they're also going to have hellacious prepayment penalties. I've got a 200-unit property in Austin. If I want to sell it right now early, pay off the loan, I have a $4 million prepayment penalty. And that's not a joke. $4 million, right? So if you get recourse, very often there is no prepayment penalty, or it's very, very small, relatively speaking. Very often you'll see a 3-2-1 structure, meaning if you pay it off within the first 12 months, you have a 3% prepayment penalty. Year 2, 2% prepayment penalty. And year 3, a 1%. And then after year 3, you could prepay it without any penalty. So why would you want to give up the non-recourse safety, right? Well, because if you're going to buy a deal, and the whole idea behind this deal is to get in fix it up, and sell it. Let's say you're buying it, it's profitable, but you have a great idea for value creation. So you want to sell it at the end of the second year, like the deal I talked about earlier. If I have a prepayment penalty on that thing, on Fannie Mae or Freddie Mac that came with that non-recourse, that deal, I can't just go sell it at the end of the second year without it being assumed by the buyer. Well, what if interest rates go up between now and then? I mean, go down between now and then. They're not going to want to assume my loan because they can get a better loan on the open market. So now if I have to sell at the end of year 2 for my business plan to work, well, now they won't be able to assume it because they can get better debt on the open market. So I have to sell it, pay off the note, and walk away. Well, I might have a $1, $2, $3, or $4 million prepayment penalty. So even though non-recourse is available to you, what are you trying to accomplish with this deal? What is your planned exit? And another thing new syndicators are not thinking about, how do I get out of this? You got to think about that. So again, there are times you would still want recourse even though non-recourse is available to you.
Yeah, we should probably do an episode on structuring debt and the different ways that your loan could be handled depending on what your goals are for the project. Because, I mean, that's exactly what I was going to say. I mean, one way of getting out of those prepayment penalties is by having an assumable loan. But you can't always negotiate that, or maybe you don't know what assumable means. And I think that there's so much that goes into that, and that's a critical component to these deals, right? I mean, a lot of these deals work because of the debt terms. That's why they're based on cap rates. So, but yeah. Anyway, got off on a tangent. Let's jump back into compensation. So we've covered promote. What's next?
Okay, so I would say probably the next thing, because it'll happen at the beginning usually, is an acquisition fee. So we'll talk about acquisition, disposition, and refi. So disposition only means you're going to dispose of the property. It's a sale. And then refi means you're just going to restructure the debt. And now it can mean a true refinance, meaning you pay off the original loan and get a new loan on it at a higher rate, or a higher level, I should say. Or you can do what's called a supplemental. So anytime you restructure the debt on the deal, that's considered a refinance of the deal. So these fees on an acquisition fee, Tyler, you talked about why the deal sponsor will get paid an acquisition fee, right? So it's usually what I typically see is 2 to 4%. I've seen as low as 1%, and I have seen as high as 4%. The most common that I see though is 2 or 3% on an acquisition fee. Again, the entire deal is the cost of the deal. Closing costs, acquisition fees, development fees, all that stuff. Is that still within 10% of the purchase price? If so, you're probably okay. You're probably still going to be in a good deal. And so on an acquisition fee of 2%, you're getting compensated for what Tyler told you, but you're getting compensated the day that the project closes. So as a deal sponsor, you have to account for that in your cash raise. You have to think, okay, I'm going to make a 2% acquisition fee for all the headache and stress that goes into buying these things and all my staff that I have to pay to get this thing closed, right? So now you have a big tax burden that you're going to have to pay taxes on. Well, that's what an acquisition fee is. If you get above 4%, to me, that's getting a little greedy. But again, I have seen as high as 4%, but that's one way that you can get paid pretty quickly. Now, what a lot of people will do with that acquisition fee as a deal sponsor, you'll take that and roll that in as your contributed capital. Most investors are going to want to see that you've put some of your own money into a deal for them to feel comfortable for you to give you their money, right? So let's say you have that $10 million asset that you're buying. You have a 2% acquisition fee. So you're going to get $200,000 for all the headache and hassle that went into getting that thing under contract and closed. Again, you have to pay your staff. You have all kinds of expenses that you have to pay. So $200,000. Let's say your expenses are truly, 50 to 100, maybe $150,000, and you get to actually earn 50 to 100,000 of that 200,000 for all of your personal work. Well, many times people will take that, say $100,000, and that will be their investment into the deal themselves. So, there's creativity that you can use in those. Some people don't take their acquisition fee. They earn it, but they don't take it until they sell. I've seen some people do that. For tax reasons, that's what worked out best for that deal sponsor. So again, they earned a 2% acquisition fee on the front end, but instead of taking that $200,000 fee at the front, they take it at the back. Say, I earned it, but I'm deferring it until we sell. Again, that's what the acquisition disposition, that's what all those fees are there for. But again, you can get as creative as you want to as long as you can explain it to your investors and they're comfortable with it. On a disposition fee, that's usually going to be about 1% because there's not nearly as much work that goes into a refinance as a brand new purchase. I've seen it as high as 2, and there's nothing wrong with that again, but it's usually 1 or 2%. And on a sale, again, a sale still doesn't have as much to do as a purchase. So that's usually 1 or 2% as well.
Yeah, so keeping them lower there. I mean, this may be a silly question, but if you technically earn a 2% acquisition fee on the front end, and you're not going to get paid until the back end, I mean, wouldn't you still incur taxes on that because it's earned day one?
I'm not a CPA, but I don't believe so because you've booked it, but you haven't received it, right? So it's owed to you at the end. It's deferred compensation. So you're not going to actually get it. So no, I don't believe that you're going to pay anything on that until you actually see the money.
Okay, interesting. So
yeah, and again, the person that I heard do that, that was why, because they had a tax situation personally that they really didn't want to take in another $200,000 in income up front.
Right.
And then get hammered on that. So they knew in 5 years when we project to sell this, my tax situation, I'll be able to handle the tax burden of that $200,000 a lot easier back then. So that's why they did it.
How much do you think a sponsor should be putting into their own deal? I mean, I know that there's a many different trains of thought when it comes to this, but your first deal, right? We've talked about this before. You were the biggest investor in that deal. I would imagine now you've got investors that are the biggest investors in the deal, and not necessarily you. But I mean, what are your thoughts on that?
Well, so you have to come to that decision on your own, but it's got to be enough to get your investors comfortable. So that to me is the bottom line. What do your investors expect? And you got to do that, right? So what I will always, my first deal, I put in $115,000. The next person behind me was $100,000. It was important for me with no track record, no experience. I wanted to show them beyond any doubt that I am determined and I am bought in all the way that this has to work. I've got more money on the line than anybody. And also on my first deal, I didn't take a promote at all. Zero. I realized I had no experience. I had no track record. You are entrusting me with your money. I'm not going to take any premium compensation. Yeah, that sucks. I'm doing a lot of damn work. I'm signing on the loan, but it was worth it for me on that first deal to prove to my guys that, look, I'm in this with you. I will take all those fees on the subsequent deals that we do together, but on this deal, I just want you to know that I am all the way in this. If it doesn't perform, I don't make a damn dime because I only get paid like you get paid, and I invested the most. Nowadays, I do have that track record. I do have that experience behind me. And so I will always contribute at least my minimum investment requirement of an investor. Most of my deals, there's either a $50,000 or $100,000 investment minimum per investor, and I will always come in there or higher. My family has always contributed probably 2 to 3 times the minimum investment. Now, I might not always do that, right? Maybe I will only invest the minimum someday. But to date, like on one deal, we had a $100,000 minimum. My family put in $400,000, right? But I always want to have at least the minimum that I'm asking them to come in with.
Yeah, I think that's pretty fair. I mean, that right off the bat, it's like, I mean, how's an investor going to argue that? Right? Like, no, look, I'm putting in the minimum that I'm asking you to put in. So I think that's pretty smart. One thing that I was thinking about is with the acquisition fee, you were talking about an alignment of interests, and it's very important to have an alignment of interests, whether you're the LP investor looking at the GP or you're the GP looking at the LP. You want to make sure that at every point, your interests are aligned as much as possible. And so that's why we, on our acquisition fees, we don't charge 4%. We don't charge 5, 6, 7%. It doesn't make any sense. It's not an alignment of interest to us. 1% to 2%, 3%, depending on the deal, that makes sense because there's a lot that we need to be compensated for on the front end, but we're not trying to make our money on the front end. We're trying to make our money throughout the deal. And if a sponsor is going to come in and charge a 5% acquisition fee, they're making so much money on the front end. How are they going to really, I mean, I'm not going to say how. are they really motivated to, do well
Yeah,
throughout
they
the
don't give a
project? I
shit.
mean,
They don't give a shit if it performs or not. They got paid.
yeah, they got paid.
Yeah. Yep.
So that's one of those fees that you want to be very cognizant of, whether you're a GP or an LP investor. Look at the acquisition fee. It kind of tells you how the group is looking at it. I mean, we're doing a fairly large deal that's set to close sometime this month, and we're taking a 1% fee on that, right? We're not taking 4 or 5% because, again, we're trying to align our investors' interests with us.
Right. And it goes back to like the commission a commercial real estate broker will charge. If I'm selling for somebody a 50 unit property, I may charge a 4% fee. If I'm selling somebody's $300 million project, I'm probably not going to charge that much. I'm only going to charge a half a point or a full point because at some point, 5% on a little bitty deal is still not that much money. 5% on a monster $1 billion deal, dude, that's $50 million. That's egregious to me, right? So it's kind of a reverse sliding scale, I guess you would call it. So the larger the deal, typically the smaller percentage in an acquisition and a disposition fee that I see. Not to say that it will scale down with size going up, but that's usually the way we do it. If it's a large deal, I won't charge more than 2%, and very often I'll charge 1%. If it is going to be, a very small deal, maybe it's only a $2 million purchase, I may charge that 2, 3, or maybe even a 4% fee. I've never charged a 4% fee. Don't get me wrong, but I'm not saying that I won't. I haven't had many acquisition fees in my career. It's not to say that I won't have them. Every deal's different. Do I feel it can support an acquisition fee? And is there a legitimate reason for charging it? Well, then I would charge it. If I can't really justify it, or the returns are so slim that it works, but only if I don't charge an acquisition fee. Well, I'm willing to give up the acquisition fee to make the deal work for the investors. Because again, without the investors, I can't do the deal anyways. So, again, everything keeps coming back to it's deal specific. It's always different. What works in this deal? What works in that deal? What are your investors comfortable with? Understand concepts, understand definition, what it all means, and then put together the best deal you can for your investors that will also financially reward yourself.
Yep, totally. So other ways of compensation. I mean, I know that you haven't mentioned this one yet, but I think it's probably worth discussing because we've had investors approach us solely for this fact is the depreciation and the write-offs. I know that's not really compensation per se, but I mean it kind of can be. Can you dive into can you dive into depreciation and write-offs and how that works?
Yeah, that's a long conversation. So let's first hit on asset management and property management, and then we'll go into that because these will be really quick. So, I'll just give you a definition. It's really straightforward. So, a property management fee is a percentage charged to the property or the ownership entity that owns the property for the day to day operations of the property. It's that simple. It does not include payroll. If you hire a third party property management company and you give them a 3% fee, they're not paying the salaries of the staff that's on that property out of that fee. They're two completely different and independent expense line items. You have to account for them both. But a property management fee is basically a percentage charged on a monthly basis on all income collected. If you bill out $100,000 in rent, late fees, administration fees, laundry income, all that stuff, if all the income is 200,000, but you can only collect 100,000 of it because a lot of people aren't paying rent and you don't know how to collect from them. You're scared to go knock on their door, or your staff is scared to go knock on their door. You bill out 200,000, let's say, and you only collect 100. You only get paid that property management fee on the collected amount. It's not fair to charge it on shit you can't collect on. That's ridiculous. So if you have a third party property management company, you will pay this to them. If you have your own property management company, or you are acting as the property management company, because maybe you're small, it's your first deal and you don't have a true company, but you are the property management company yourself. You're wearing every freaking hat. Well, then you will make that 3 to 5%, whatever you're charging yourself. So that's a compensation piece. And then the second piece is the asset management fee. The asset management fee is paid to basically operate the company that owns the asset. The asset manager is responsible for the performance of the property management company. If they're not executing, if they're not performing, you need to fire them and get somebody else. You're operating at the asset level, not at the property level. So there's a fee for that as well. And that's typical. Almost every deal ever done will have an asset management fee. Don't let that freak you out. It's usually 1 to 2%, again, of monthly collected revenue. It's that simple. Those are those two fees. So those are two other ways. Most people that do these deals, they will collect an asset management fee because they're the ones going to be running the asset, not necessarily the property itself, but they'll be running the company that owns the property. Most people that do this, though, about 80 to 90% of this industry, they're going to hire a third party property management company. So you would give that management fee to them.
Yep, exactly. I mean, and of course, there's profit built into that, right? I mean, nobody's going to
Of
hide
course.
that fact, but there's a massive amount of expenses that go into that too. I mean, you think
Yeah.
about the staff that Bruce and I have. The only reason that we can have the amazing team that we have is because we charge those fees to help pay for it, so that our investors, every time we go into a deal, we make sure we do all the proper due diligence and all the right underwriting. We do all the right research, and we inspect every part of the property. And that's what the whole team is there for. And so that's what those fees end up paying for.
Right. Like you said, it's a company. Every company is in business to make a profit. I'm not going to have the company if there's no profit in having the company.
Right.
But yes, our asset management company that we operate in Central Texas, we have a full bookkeeping department. We have a full operations department at the corporate level. We've got to pay for those people, right? Because we have to operate the asset or the company that owns the property. So, yeah, they're legitimate fees. Again, it is a business, to your point. So there is going to be profit. It's okay. Businesses are in business to make profit. We're not doing this for free. So that's those two fees. So now we wanted to talk about depreciation. We'll wrap it up here because it'll be a
Yeah.
little bit of an extended conversation. So depreciation. This is one of the big reasons we buy commercial real estate. Okay. As a refresher for those that don't remember or maybe don't even know what depreciation is. The IRS has set out depreciation tables or schedules to say every capital asset, so every big expensive asset out there, it has a schedule of time that if you don't repair it, fix it up, take care of it, it will completely fall apart and dissolve into dust and go back to Mother Earth. An apartment complex, the IRS has deemed that in 27 and a half years, if you do not take care of the asset, it will fall apart and be worthless. True commercial outside of multifamily is 39 years. So what they say is the value of the improvements of that property. What an improvement is, anything built on top of the land, everything. Well, some of it will be built in the land, like irrigation, things like that, your sprinkler systems. Some things are built in the ground, but anything outside of the land itself is considered an improvement. Your signage, your parking lot, roofs, the construction of the building itself. Within the units, you've got carpeting, you've got appliances, furniture, maybe if they're all expenses. So it's all that stuff. So the IRS says 27 and a half years, all this will wear out. Let's go back to our $10 million purchase. And let's say 20% of the purchase is land value and 80% is the improvement. So the improvement is valued at $8 million. If you take that $8 million and divide it over 27 and a half years, let me get my calculator. So you've got $8 million, because remember, you can't depreciate land, it doesn't wear out, right? So divided by 27.5 years for an apartment complex. Each year, I get a write off of $290,000 because, in theory, the value of the property has gone down by $290,000 because of depreciation. So that's an expense for the company, right? So at the end of the year, whatever the property's loss or gain is, you as an individual investor in that LLC, because most of them are going to be done as an LLC, you get your percentage ownership benefit of that profit or loss. So if the property reports on its tax return to the IRS $100,000 profit, and you own 10% of the equity in the deal, then you owe 10% of that. So if you have $1 million profit, I don't know what I said, but let's say I said $1 million profit and you own 10% of the deal, you have a $100,000 profit that you have to report on your personal tax return at the end of the year. You have to pay taxes on that, right? When we employ depreciation, we add more expenses to offset all the income. We may have been profitable from a cash flow standpoint. We put money in our pocket, but because we had enough depreciation expense, we show the property was actually run at a tax loss, right? Some people call it a phantom loss, a phantom expense, because it's a legitimate expense you're allowed to take by law, but it's not actual cash leaving the business. So since it's not cash leaving the business, it doesn't truly affect the profitability in your pocket. It does affect the way you report profitability to the IRS. So if you have enough depreciation, let's say in that property you had $1 million profit that year. Well, okay, you have $1 million profit, but let's say after you put the depreciation into it now, let's say it's a massive property, and instead of $1 million profit, you have $2 million worth of depreciation because of the size of the asset. Well, now if you think about it, you had $1 million profit, $2 million in depreciation expense. So now you show a paper loss to the IRS on your tax return of $1 million. Same thing.
So
You
we
get your
actually had a
portion of that
client.
loss.
We
Okay.
actually had a client that that did that. So they developed a 140, 150 unit apartment complex. This is 3-4 years ago, and they showed a profit technically of $1 million year one after the lease up, and they did a cost segregation study, and because of that, with the accelerated depreciation, they showed a $500,000 loss.
Mhm.
So
Yeah,
I mean that's
absolutely. So
pretty
most of our
powerful.
oh, absolutely. Most of our properties run a 20 to 30% net margin. Well, that means all the income that I bring in, 20 to 30% of that falls to the bottom line in the form of free cash flow. So I'll run a net margin of 20 to 30% on these projects, but we'll show a loss to the IRS because legitimately and allowable, we factor in a lot of depreciation expense. So we end up running $1 million to $2 million loss, even though we pocketed a big profit that we were able to distribute to our investors. So we're talking about depreciation in regard to the way it factors into the deal sponsor. If the deal sponsor takes his promote or her promote in the form of equity, so let's say I have a 20% promote and I take it by owning 20% of the company for my promote, well, then I get 20% of that paper loss that we reported to the IRS that I can use on my personal tax return at the end of the year. That could be massive. I have hundreds and hundreds and hundreds of thousands of dollars every year in depreciation expense or losses generated by these properties that I can show on my personal tax return because we have a ton of depreciation expense on these deals. So it's a big deal. And the way you structure your promote can really affect that too. And we've talked about that in previous episodes. I've written an article on that on LinkedIn. You can go understand fully how you structure your promote can affect that depreciation expense. And there's a big benefit there if you do it the right way.
Yeah, like I was saying, there are investment groups that will target development deals for this specific reason because you can get the losses on your K1s while you're under development, right? And then you get all this depreciation. The returns are great, right? Like they want good returns too, but they have so much income coming in from all of these other projects. They're trying to find a way to shield that. And so that's a great way to do it is through these, K1 losses and depreciation. So there's any number of ways that you can really be compensated in commercial real estate, which is fun. And it's also an investment vehicle like no other. You can't get that from stocks and bonds. You can't depreciate stocks and bonds. You don't get,
The company you're investing in is doing that.
right.
You know,
They get
the
all the
stock that you buy in
benefits.
Apple, they're running depreciation through their company,
Yep.
guaranteed. They, all of us do it. So yeah, go out and own a business or a piece of a business instead of a stock. Now, a stock technically is ownership of that business, but yeah, that gets a little weird. But yeah, when you buy stock, you don't get benefit of any of that depreciation at all.
Not at all. Not at all. And that's, they say historically the stock market has outperformed real estate, in terms of appreciation or whatever. I mean, when you take into account the depreciation and write-offs and everything that you get out of real estate, I have a hard time believing that real estate doesn't just kick stocks' asses.
Right. Okay. So when they say that, typically, now some people might describe it differently or explain it differently. What I almost always see, what they're talking about is the appreciation. That's all they're talking about, right? So they're saying that real estate doesn't go up as much in value each year, like as the stock market does. Well, absolutely, you're right. historical average returns for the stock market going back to 1929 is roughly what, 10.5%?
Yeah.
You're right. I might not get that in appreciation, but we're not talking about appreciation here. We put debt on these properties. So first of all, that 3% appreciation might be closer to 10% for you because you didn't write a check for the whole damn thing. You took out a loan, right? So let's think about that. Let's say you buy a $100,000 house as an investment property and it goes up 3%. It went up $3,000 in that year. But if I only put $30,000 into the house between the down payment of 20% and maybe 10% for carrying costs and rehab and all that stuff, right? So a $100,000 house cost you $30,000 to purchase. That 3% increase in value was $3,000 on the value of the home. But I only invested 30,000. So that's 10%, right? And it's even more exaggerated in multifamily. But then they also don't factor in, you're right, the benefit of all the depreciation you can get out of these if you do them properly. So yeah, it's to me, it's a stock market guy or girl or lady or a financial advisor that doesn't have any exposure to real estate. They don't want you to take some of the money that you're going to invest with them and put it somewhere else. I think it's disingenuous when they say that stuff because if you do this properly, real estate will destroy the stock market.
Well, they have a major conflict of interest, right? They
Yes.
can't collect a percentage on the money that you're putting into real estate, which is why that's why, I'm not going to name it, whatever the big names are of the money manager companies. We all know them, right? Because all of our friends went and worked for them after they got out of college. But those guys are literally, they will get fired if they recommend real estate to any of their clients. They're actually not allowed to do it because the firm can't collect any fees on that, which is unreal. I mean, it's a clear conflict of interest. I don't understand how they can claim to have a fiduciary responsibility to their clients and helping them diversify their portfolio and not recommend real estate. I mean, it's mind-boggling to me.
Right. Now, having said that, to be fair, if you get a very good certified financial planner or you get an RIA, a registered investment advisor, people like that, very, very often the right people, they are saying, hey, you need to put some of your money in real estate. So you're right. There are a ton of companies out there that don't talk to you about it. They don't want to lose any of your money. But the really good ones, they're going to try to source deals that you can invest in that they can take their little 2% management fee on. So there are a lot of good ones out there, and we work with a few of them. But you're right. There are a lot of them whose interests are not completely aligned with yours.
Well, and those are the smaller independent guys, right? Like if you're working with someone again that's not a local independent guy, and you're working your financial advisor works for a big firm, they are incentivized to promote stuff that big firm makes more money off of, and they cannot charge anything for real estate, so they're not allowed to get that in front of you. So yeah, I mean, we're not here to talk about financial advisors, but that's always so frustrating to me. It's like real estate makes so much sense to have in your portfolio. I mean, I had a conversation with an investor yesterday, and they are very heavily into the stock market. I mean, almost 100% of their portfolio is stocks. And so the reason they called me is that they wanted to diversify into real estate. And so we just got to talking about, the bear run that happened around this time last year when COVID hit, where it was like Wednesday record stock market lows, Thursday record stock market lows, Friday record stock market lows. And, I was sitting there going, well, I didn't have anybody calling me saying, hey, your real estate's gone down 10% today. Hey, real estate's gone down 20. I mean, it doesn't happen in real estate. So we were sitting there watching the stock market going, damn, good thing we don't have a whole lot in the stock market right now.
Yeah, I am a stockbroker from the 90s, right? That was one of my first jobs out of when I was trying to go to college, right? So I did it for a year until I realized I didn't like it, right? So I still have some exposure. I have about 5% of my net worth in the stock market, but yeah, almost all of my money is in some form or another invested into real estate.
Yeah, that's how I am, right? I mean, it's tough to. I've got crypto, right? But outside of crypto, it's all real estate. And that's, again, we're real estate professionals, right? We understand real estate better than we understand the stock market. If I was a stockbroker, I'd probably have 95% of my portfolio in stocks just because that's what I understand.
Right, and it's not to say that investing in the stock market is bad, right? There are a lot of people out there doing very, very well in it. We're just talking to you about real estate now and why we think it's a great investment vehicle. There are a lot of people doing very well in the stock. I do great in the stock market, but I still have most of my money in real estate.
Yep. Awesome. Well, that's a great way to end today's episode. Don't forget to join us live on Fridays at 10 a.m. Central Standard Time if you want to jump in the live chat and ask us any questions on anything that we're talking about. And don't forget to like and subscribe if you're watching us on YouTube. And please rate and review if you're listening on iTunes. And we will catch you guys next week.
Later.